Okay, hello and good afternoon, everyone. Thank you all so much for taking the time to join this webinar today. I appreciate it. I'm Josh Harris, and I lead growth, revenue strategy, and partnerships here at AlphaThena. Advisors are constantly looking for ways to stay ahead of the curve, but most of the industry is still stuck thinking of direct indexing as just a long-only strategy. The reality is long-short direct indexing is opening up a whole new playbook for tax efficiency, portfolio precision, and client engagement. Today, I'm going to show you what that looks like. As we go through this presentation, I'd encourage you to drop any questions into the comment section. I'll keep an eye out and address them at the end of the session today. So here's what we'll be covering throughout the session. I'll start with a quick overview of AlphaThena just to set the stage. And then we'll go into what long-short direct indexing really means and how it works in practice. From there, we'll walk through the benefits versus traditional long-only direct indexing, especially where it opens up new opportunities for tax efficiency and portfolio precision. We'll also spend some time on how tax loss harvesting fits into the picture, along with some practical considerations around implementation. And finally, we'll wrap it up with a live demo so you can see exactly how all of this comes together on the AlphaThena platform. All right, so let me start with a quick overview of AlphaThena. We're an AI-powered direct indexing platform that helps advisors deliver personalized portfolios, systematic tax loss harvesting, tax-efficient transitions, and concentrated position management, all in a way that's scalable and easy to use. One of the things that really sets us apart is our bi-directional custodial integrations. So we connect directly with Schwab, Fidelity, and other custodians, and we've built an open API architecture that makes true household level management seamless. Our team comes out of places like Vanguard, MSCI, Bloomberg, CapTrust, Oppenheimer, and PwC, and we're headquartered right here in Chicago. The DNA of the company is about combining institutional expertise with technology, and that really makes advisors' lives easier. At the end of the day, AlphaThena is designed to complement your in-house investment strategy, giving you more control while strengthening advisor and client relationships through smarter personal portfolio personalization. So before we get deep into long-short, let's take a step back and look at the foundation, long-only direct indexing, which is where most advisors start. The real value here comes in two main areas: customization and tax loss harvesting. So on the left of this slide, you'll see how easy it is to align a portfolio with a client's values or needs. You might remove Microsoft if they already hold it in a 401k, tilt more toward green energy by overweighting Tesla, or screen out oil, gas, or tobacco. On the right, you'll see tax loss harvesting in action. When a stock like Nvidia, Lilly, or JP Morgan is down, you can swap it for highly correlated replacements like Intel, Johnson & Johnson, or Bank of America. That way you capture the loss for tax purposes, but keep the portfolio on track. And when you put customization and harvesting together, you get the numbers you see here on the right. Very similar returns to an ETF, but with added after-tax benefit, and some years adding as much as 7% to client outcomes. So long-only direct indexing already creates significant value, and now we'll explore how long-short takes that even further. So when we talk about direct indexing, what we mean is owning the individual stocks of an index like the S&P 500 instead of just buying the ETF or a mutual fund. So long-short direct indexing takes that one step further. It's not just about holding the long side of an index. You can also short certain companies or factors. That gives you the ability to reduce exposure to areas you don't believe in while still keeping control of the overall portfolio. So how does shorting actually work? In practice, you are borrowing shares from a broker like Schwab or Fidelity and selling them right away. The price of that stock goes down and you can buy it back at a lower price, return the shares, and pocket the difference. Of course, the reverse is true as well. If the stock goes up, you'll have to buy it back at a higher price, which creates a loss. And while the position is open, you're also paying interest on those borrowed shares. The key difference here is fairly simple. With long positions, you want the stock price to rise. With short positions, you want it to fall. And that added flexibility is what makes long short direct indexing so powerful. So let's break down what a 130-30 strategy structure actually looks like, for example. So if you start with $100 in initial capital, here's the flow. You'll short $30 worth of stocks you expect to decline. That frees up some additional capital, which you can then use to go long $130 in stocks you believe will rise. So in total, you'll end up with $160 of gross exposure, which is 130% long and 30% short. But your net exposure is still $100. In other words, your beta remains right around 1, which means you're taking on the same overall market risk as a benchmark, but with more flexibility built into the portfolio. The picture here helps make that distinction a little bit more clear. And in a long-only portfolio, you've got just 100% long exposure. But in a 130-30 strategy, you're layering in a 30% short on top of the 130% long, so that you still have full market exposure, just with more levers to add value. Now that we've seen the benefits of long-only direct indexing and long-short, let's dive deeper into some of the benefits of this long-short concept. Traditional direct indexing only customizes the long portfolio, as we discussed earlier. Long-short adds hedge fund-like flexibility but with transparency and tax efficiency of direct indexing. The real advantage is consistency. You can generate tax losses in rising and falling markets. And the data proves it. So you'll see at the bottom, that little graphic there. Over 10 years, long short has produced 2.7 times more capital losses than long only portfolios and delivered about 4.4% in average annual tax alpha. So in practice, this means more efficient harvesting, the ability to tilt towards desired themes while shorting out unwanted exposures, and better risk management by pairing longs and shorts to control beta. So in short, it expands the playbook for advisors and PMs while keeping full control in-house. So this slide is all about the mechanics of tax loss harvesting in a 130-30 strategy. So on the long side, it works just like you'd expect. You harvest losses when prices fall. On the short side, it's the opposite. So you harvest when prices rise because that's when the short position is losing value. So in a bull market, your longs are going to be up, but your shorts are down, which creates harvestable losses on the short side. In a bear market, the inverse is true. Your longs are going to be down, but your shorts are up, creating harvesting opportunities on the long side. And the key takeaway is that unlike long-only strategies, long-short gives you a harvesting lever no matter which direction the market is moving. The consistency is what makes it such a valuable tax efficiency tool. So the first step in implementing long-short direct indexes is the setup. That means establishing prime broker relationships with custodians like Schwab, Fidelity, or Interactive Brokers, for example, and setting up margin accounts so that you can take on the short exposure. Once that's in place, you move into positioning. Here you're building out the 130% long side of the portfolio and layering in 30% short exposure on the names or factors you want to bet against or neutralize. From there, it becomes about monitoring. So you're tracking the profit and loss on a daily basis and watching for harvesting opportunities as those markets move. Finally, you have the harvest step itself, which is realizing those losses in a way that captures the tax benefit while making sure you're avoiding wash sales and keeping the overall strategy intact. So the process is very straightforward: set up, position, monitor, and harvest. And once the plumbing is in place, it becomes a systematic and repeatable workflow. So when you move into long-short direct indexing, there are a few important considerations to keep in mind. First, you have to track wash sales across both long and short positions. So if you close a short at a loss, you can't then go long the same security for 30 days. Similarly, if you sell a long at a loss, you can't short it within that window either. And it's not just within one account. You need to monitor across full households, including and all accounts, including taxables, IRAs, and spousal accounts. Second, there are margin account factors. So you'll be dealing with the short rebate rate, which is effectively the cost of borrowing shares. And that cost can vary a lot depending on stock demand. Transaction costs also tend to run about 1.5 times higher than long-only strategies. And then, of course, you have Regulation T, which requires a 50% initial margin within the account. So violations here, Regulation T violations, can result in trading restrictions. And finally, this strategy is really best suited for sophisticated investors with a certain amount of capital. It's valuable for clients with regular capital gains, concentrated positions, or those anticipating liquidity events. It also helps when there are large embedded gains or a need for tax-efficient diversification. And importantly, it's especially effective for clients realizing regular short-term or long-term gains, since harvesting losses offsets those gains so efficiently. So while the strategy is powerful, it's not for everyone. It's best deployed with the right type of client and careful oversight. Here's a quick case study to show you how all of this works in practice. This client had a $4 million taxable portfolio heavily tilted towards growth due to concentrated equity compensation that they had from a previous employer. They were realizing regular short-term gains as well. And with long-only direct indexing, we could replicate the benchmark with some customization, but the growth tilt still stayed in place. So that left the portfolio overexposed, and harvesting opportunities was limited to down markets only. With long short, we added a value factor tilt for diversification and shorted positions inversely correlated with the growth factor to offset that bias. We found over 18 months that approach generated about $300,000 in harvested losses, which is really impactful to the overall portfolio. And that portfolio maintained a beta of 1, reduced unintended growth exposure, and consistently generated tax alpha across cycles, all without forcing liquidation of concentrated holdings. So that's really the power of long-short direct indexing within a real client scenario. So as we wrap up this deck, I want to bring it back to why firms are choosing AlphaThena. On the platform side, we deliver comprehensive personalization with custodian agnostic turnkey integration. So your assets stay under your control. We've built advanced optimization tools and API-first architecture that makes workflows simple and scalable. And because it's end-to-end lifecycle management, you can design, invest, transition, rebalance, harvest, and manage everything in a centralized fashion in one place. On the business side, the impact is just as important. AlphaThena helps you grow your business by building and managing complex portfolios while creating richer client experiences that drive retention. We keep costs low so you can stay competitive and reflect true value to your clients, and give you access to cutting-edge technology with the scale to grow alongside your firm. Most importantly, we make it easy to get started right away, plugging into your existing processes and workflows, so you can start delivering personalization to clients from day one. That's what AlphaThena is all about, giving you the control, scalability, and efficiency to run personalization in-house and deepen those client relationships that matter most. All right, so enough slides. I know you didn't join today just to watch me read bullet points. This is the part where we actually hop into the platform and see how everything comes to life in practice. I'm gonna stop sharing my screen here. Okay. Okay, hopefully everybody can see this screen. So if you joined our webinar a couple months ago, where we walked through the full platform and did a demo, a lot of this might look the same. What we're going to focus on today is, again, long-short direct indexing. So just as a refresher, our platform provides capabilities across the full investment management lifecycle, everything from creating direct indexes to managing model portfolios to investing client assets into those investment strategies, and then managing them on an ongoing basis and doing things like tax loss harvesting, rebalancing, and managing concentrated positions. We're going to start with the create and personalize screen, where we'll create a direct index. And I'm going to start with long only just to show you how it looks like. Again, just a quick refresher. As a reminder, we have over 1,800 indexes and ETFs to choose from. Today, I'll choose SPY, S&P 500. All of those constituents have loaded up into the create screen here. So you'll see about 500 securities. And we will start by setting our smart weights objective and kicking off the optimization engine. So we're going to set that smart weights objective as minimizing the tracking error. What that's going to allow us to do is reduce the number of constituents in the direct index to whatever we like. Here, I'm just going to use 200. What's going to happen here behind the scenes is our proprietary optimization engine is going to reweight the securities, the underlying securities in the direct index, in a manner that reduces your tracking error. So again, we're taking 200 securities derived from the S&P 500 or SPY, and we're optimizing this direct index. So smart weights, you'll see it here in this column. Those are weights that are derived from the optimization engine that reduce our tracking error down to about 29 basis points, which is pretty good. So this is just your plain vanilla long only direct index. Again, 200 constituents, 29 basis point tracking error. If you want for your clients, you can incorporate the customizations that you see here on the left-hand side of the screen. But we're going to get into why you all came to this webinar today, which is long-short direct indexing. So flipping back to the right side of the screen, once we have this optimized long-only direct index, basically the only difference between long-only and long-short when you're creating the direct index on the AlphaThena platform is in terms of workflow, is adding the leverage amount here. So we have some pre-populated leverage amounts, 30%, 50%. Those are 130-30 and 150-50 strategies. You can also go up to as large as 200 over 100. But for the sake of example today, we're just going to use the 130-30 strategy. I do want to preface, it's very important, critical that clients have margin accounts in order to do this. Otherwise, you won't be able to create those long short direct indexes like we're doing now. So again, 130-30. The next step in the process is to add a factor tilt. So what's happening here behind the scenes is the short positions that you're adding to the direct index are going to be inversely correlated with that specific factor like we talked about earlier. So here, I'm adding quality as the factor tilt, going to set it at 5%. And I'm going to click this check mark to apply that criteria. So now we'll have our long-short direct index. It'll take a few seconds to load. And here you have it. So long-short direct index, because we have 200 constituents within this portfolio, that's what the long-short construction is referring to. So you'll notice here, this little left-hand side yellow box, we have 158 longs, 42 shorts, adding up to your respective percentages. Tracking error increased a little bit, so now it's 1.1 or 111 basis points. And you can see the long positions here. If I sort them by descending, you'll see the short positions. Republic Services, Martin Marietta Materials, Brown & Brown, those are positions that we're going to have be short in our direct index. Right-hand column includes short fee. That's how much you're going to pay on the open interest for these securities within the direct index. And if you want to take it a few steps further, we have some constraints to incorporate for the index. Things like long weight constraints. So that's controlling your minimum and max percentage weight for each one of those securities, as well as the maximum drift. On the short side, you can do the same thing and control the minimum or maximum weight, as well as the maximum short fee. So that's how much you're going to pay on those short positions. Behind the scenes, we have a risk control that prevents you from shorting any more than any positions with dividends. So you're not going to be able to, it's going to prevent you from shorting no more than 2% of any position with dividends. So just some back end risk controls that you won't necessarily see, but they are happening on the back end there. So now we have our long short direct index. We can go ahead and save it. We'll call it Josh's long short. S&P. All right, now that's been saved. And I'll flip over to the Invest tab to show you what it's going to look like to invest a cash account in that long short direct index. So you'll see my namesake account has loaded up at about $2 million in cash. So this is just a cash only portfolio. We will allocate all of the cash within that portfolio, or that account. So we've got $2 million in cash going to work. This is going to, once I click create draft order set, we're going to have optimized allocations across all of those positions within the long short direct index that we just created. So it's going to have long positions here, NVIDIA, Microsoft, Apple. And then when I sort again by descending, you'll see those short positions and their respective optimized allocations. Overall, we're allocating almost all of that $2 million in cash, all of the positions within our long short direct index. When we're ready, we can preview and submit those orders. So now you've created your long short direct index. You've invested an all cash account in that direct index. And now I'm going to show you what it looks like to tax loss harvest a long short portfolio. So I'm taking a different account here. This account's already been invested for quite some time. It's invested in a similar direct index that we just created, SPY, long short. Right now it has about $750,000 invested, a little bit of cash. As a reminder, the tax loss harvesting, the way tax loss harvesting works is those losses that become present when I click harvest account are coming from parameters that are being set by portfolio managers or advisors. So things like minimum dollar amount percentage threshold. So anytime a loss exceeds those thresholds, it's being presented here in the tax loss harvesting functionality. You can also customize it, include client-specific tax rates. And there you have it. So you'll have all of your losses here. Those losses in red, so United Airlines, Welltower, Tapestry, those are going to be your short losses. So those are positions that have risen over time and presented loss opportunities. The inverse is true with the green positions. These are positions that are long only, but went down over time, so they're presenting tax loss harvesting opportunities there. Overall, within the portfolio, and where this becomes so impactful is the tax savings figure up here in the right-hand corner. So what this is saying is right now, by doing this tax loss harvesting exercise, you can save your client that's invested, that has $750,000 invested in equities, the long short direct index, about 1.7% in tax savings right now, which comes out to about 15.1 thousand in tax savings, which can add a lot of value as you're doing that throughout the year. And again, no matter which way the markets sway, up or down, you're going to have loss opportunities to harvest here. After analyzing some of the losses and the metrics up here in the right-hand corner, we can get those replacements. So once I click optimize replacements, what's going to happen here is the system's going to generate replacements for those securities. So the losses that we're selling off, we need to replace them. What we're doing here is the system just finding securities that are going to hopefully reduce your tracking error. And it's fully customizable. So you can change how many selected lots. Here we have 61 losses that we're harvesting and replacing them with a certain amount. That's fully iterative. So you can go in and change that however you want. In this case, you're replacing 61 losses with a handful of securities that are going to that are now going to be present in the portfolio. If I wanted to, I could do security level replacements as well that are kind of one-to-one. So the system's going to generate those replacements. Those replacements are correlated based off of sector and market cap. So somewhat similar to the ones that we're trading here, but most of our clients use this account level or optimized replacements feature. Once I'm ready to take these losses and replace them and generate the tax savings for the client, we can click preview orders. It's going to give us that trading interface here. You'll see the buys and sells, and we can submit those orders. Now you've saved your client 1.72% in tax savings by doing this exercise. So you do that throughout the year and you get an aggregate tax alpha figure. And that's about it in terms of the demo. If anybody has any questions, looks like we have a couple here in the chat. I'll answer those. If you want to see a deeper dive at the platform or how this works in practice, feel free to reach out. We can schedule a demo. So I'm going to stop sharing and we will answer some of the questions in the chat. First question is, how do you handle wash sales when both longs and shorts are in play? So we track across both sides of the portfolio, which means if you close a short at a loss, you can't reestablish the long side of that security within 30 days and vice versa. And AlphaThena, the platform kind of automates that monitoring behind the scenes. So, and it's done across the full household. So taxable accounts, IRAs, even spousal accounts. And what that does is it just ensures compliance across the full household while capturing those losses either way the market goes, so wherever possible. Second question we have here is, what about the cost of borrowing shares? How do short interest or rebate fees work? And that's a great question. So the cost of borrowing depends on the security's demand and availability. And it's typically set by the custodian you're working with. So Schwab, Fidelity, Interactive Brokers, et cetera, they set those short interest fees. And highly liquid names tend to be inexpensive to borrow, while crowded shorts or thinly traded names are going to be a little bit more costly. So our process factors that into the implementation. And again, you can set parameters around the short interest fee, so you're not trading really expensive short securities. And you and your clients then become aware of kind of the economics before those trades are made. So some safeguards there. Let's see if we have any more questions here before we wrap it up. All right. That concludes today's webinar. Thank you all again for joining. And if anybody has any questions or wants to see a live demo, please reach out to me at josh.harris@alphathena.com, or you can go to our website, alphathena.com, to submit a demo request. Thanks so much. Take care, everybody.